the dark side of selling covered calls. So this person sold, it looks to be covered calls on ASTS. It says sold a 32 strike on my entire position in ASTS before they started a massive move. Covered call is now at negative 1,650% return. They're down $43,496 unrealized P&L on the calls. So down below, we can see this person says, as long as the strike price is above your average cost, you're still ahead. That's the beauty of selling covered calls. You can miss out on potential profit, but you can't lose money. This is literally completely wrong. And the reason why it's completely wrong is because you absolutely can lose money if the underlying goes down. Now, somebody might say, well, no, you don't lose money unless you choose to sell your position. Well, then we still have to factor in things like opportunity cost. One of the issues with traders of this kind of strategy is they develop a disease where they just cannot look a losing trade in the face and accept it for what it is, and will do everything to avoid a losing trade, even if it doesn't make as much sense in terms of their total profitability. I literally have a long call strategy that year to date has a 47% win rate. It means I'm losing over half the time. Yet the strategy is massively profitable. And it's because the winning trades so overwhelm the losing trades that it makes a lot of money, even though I have a 47% win rate. So the broader point here is, when I'm looking at something like this, you're making a really avoidable mistake. And it's unfortunately done in the context of getting too focused on the short option component of the trade. And I want to show you a better way to think about this. So if we take a look at ASTS, let's break down what's actually happening in a covered call for those that might need a quick reminder. So if we have a covered call, there are two legs: long stock and short call. Here's the deal. This is the base position. In the military, we would refer to this as the main effort. And this is a supporting effort. Yet, most traders of a covered call over prioritize this, the supporting effort. And it's because we like credits. We like making money up front. Here's the nefarious problem with this. When you sell a covered call, your P&L plot will look like this. You will have unlimited downside risk and then capped profit potential. What's the benefit here? Why would you do this? The reason why you would do this is because if you're a little bit wrong, you can make money. And if the underlying rallies, it's still a high-class problem in that you've made money. But again, most traders forget that this is the main effort, the long stock. Short call is the supporting effort. So what this means is, if you're trading this kind of position, you have to be aware of the trade-off that you're making and at what point the inflection occurs where you make more money if you didn't have the short calls. So it's really easy to do. Let's take a look. If we analyze just a sample trade, this isn't their trade, it's using just a regular trade. In ASTS, where we're long 500 shares at 51.33, and we're short 5 contracts of the 60 call at $4.80. What's happening in this scenario? Well, first, if we take a look at the short call component, you can see your max profit here is $2,400. So that's the most amount of money you can make on the short calls, and that's if the underlying expires below your strike. Cool. Next, if we take a look at the long stock component, standard positive sloping line. Okay. So let's just do a little bit of an analysis here. If we take a look at the max profit potential on this trade, we can see that we can make up to $67.35. And that happens at around $60.40. So then if we see where we would effectively make that same amount of money, that 67.50, call it, on the long shares, we can figure out where the inflection point occurs where you're better off just having the long shares. So if you have just long shares, you hit the same P&L roughly at $64. So then it becomes a question of where do you think the underlying is going to go? Because remember, if we're holding the stock, we think it's going to go up. So if you think it's going to go up at least this amount, you're better off not having the short calls. Now, this is something that we all do not have, which is the ability to read the future. So here's a better way to think about it, in my opinion. Rather than choosing binary short calls or no short calls, trade them at a ratio. I have a video that breaks this down more in detail, but rather than selling 5, if you have 500 shares, maybe sell 3. If you sell 3, rather than making $2,400, you make $1,440. So you're losing a bit of money. You're losing about $1,000 here. However, by giving up that $1,000, you're uncapping your profit potential. So you make a little bit less of a credit up front, but you'll notice that we hit that 63.45 number now at 62.85. So what that means is you do need it to go up a little bit more in order to make that same amount of money. However, if it goes up more than that, which is the base case of why we would be holding long shares, you now have unlimited profit potential on the residual 200 shares that are not covered. It's a better way to think about this. So instead of completely covering your upside profit potential to make a few extra bucks up front, find a balance that works for you so that this way, when the underlying makes the move that you want it to do, when you're holding long stock, which is go up, you don't completely cap your upside profit potential. This is why covered calls systematically underperform, because of capping upside profit potential. Even though the markets tend to go up, you're going and flying into the wind. Yet collecting a little bit of a credit up front is nice, and that can be done effectively. So the other key downside here to pay attention to is that depending on what their total account value is, you need this amount of money in your cash and sweep vehicle in order to be able to manage this position, which is really misunderstood by a lot of people, unless you submit a straight rolling order, which effectively you would have to do, because this is going to come out of the account. And then you can put on a new trade where you cover this amount, and then that pluses up your cash and sweep, but you don't want to go on margin unnecessarily rather than just trading with margin. As always, if you have any questions or any posts that you want me to take a look at, anything you want me to review, let me know. Be an outlier. See you guys later.